I have to say, if you describe the situation like this, it sounds very positive. However, we are negative. We see downside for the market because all the points that you're pointing to, they're very valid. But at the same time, you've got in the background a very sharp deterioration of the US labor market. We've seen employment growth slowing effectively to the lowest level and slowest level since 2010, excluding the pandemic. You've got the unemployment rate being up 80 basis points. Yesterday, we had a very interesting data point coming from the conference board. Consumer getting more and more pessimistic about the outlook for the labor market. And historically, when the labor market turns, then the macro cycle turns, and it typically means wider risk premium, lower earnings. So therefore, it's hard for us to join in the general euphoria.
So in your view, potentially then the Fed started acting too late?
Well, they're doing the right thing. There's clearly been a shift from inflation concerns towards growth concerns. But we need to remember that it typically takes a year to 1.5 years for the impact of monetary policy to come through when you're tightening, when you're easing. So if you're easing now, that will have an impact on the cycle in about a year's time. But the labor market is slowing right now.
Now, looking at European equities, you said to me a little bit earlier that autos and luxury are potentially a buy opportunity now because they've been hit earlier this year and they might have hit bottom, and now it could be an opportunity.
So you've got an interesting situation where at the level of risk premium, so credit spreads, nothing is priced. They're in the bottom 3% of the historical distribution. Equity markets overall at all-time highs, but luxury already down 25% relative to the market, semis down 25%, autos down 20%. So we think that you should be very cautious whether bad macro news is not priced in, but because it's not a slam dunk. There is maybe you halt the recent deterioration in the labor market. So we think it's about 2/3 risk of a hard landing, 1/3 risk of a soft landing. So you want to buy some cyclical hedges, the ones that have corrected a lot, and specifically the ones that would benefit if bond yields decline into a hard landing. And that for us is luxury, semis. I was just in Asia, very interestingly. Nobody wants to buy the luxury because the momentum is so bad, but a lot of bad news is priced in. On autos, we would be more cautious because they are a value cyclical. They tend to be negatively impacted when bond yields decline.
Let's look at banks, European banks in particular. So they've held up relatively well so far this year, and you said this is a supportive bottom-up argument in favor of banks at the moment. So can I just get your take on that?
Yeah, it's a little bit like what we said about the economy. There are very valid positive arguments. Generally, it's a very hazy and ambiguous situation. So the people who are bullish on the banks, they say, look at the profitability, look at the cash returns, look at the valuations. Plus, you've got M&A on top of that. And I have to admit, all of that sounds very good. But this is one of the most macro-driven sectors. Anything goes wrong with the US labor market, it means yields will be meaningfully lower, risk premium meaningfully higher, and banks are enormously sensitive to these two macro variables. And secondly, unlike luxury, unlike autos, unlike semis, they haven't priced anything. They had a 5-year high. If anything, they're priced for credit spreads to tighten. So anything goes wrong in the US labor market, this is the sector that is least pre-priced for such a scenario.
And can we zoom in on French banks in particular, because they have been hit more than others in that sector because of the snap election and the potential political instability. They haven't, even the CAC overall hasn't regained ground compared to other indexes. So how do you play out the French market in particular?
So we were underweight France earlier this year. It was a cyclical index that was very elevated, partly because luxury was so elevated. And you're right that we are talking about a scenario where risk premium have to be priced in, risk premium just too tight. Generally, in France, risk premium have already expanded because you had an idiosyncratic political shock. And even though the political situation has calmed down, you effectively have a caretaker, basically very centrist caretaker government in place. But the risk premium never came down after the election. So we think France is no longer interesting as a cyclical underweight. We think it's too early to upgrade it. So we've parked it on market weight. We think it's not in the basket of the cyclical stuff that you have to buy because it's over-discounting risk, but it also does no longer belong after the correction in the basket of cyclical underweights.